A silver price of $1,000 an ounce, a gold price of $20,000, numbers like these used to belong to the fringe, not anymore. They now come from a 50-year Wall Street veteran with a track record too accurate to dismiss, from central banks buying gold at a pace that has already flipped the balance of global reserves, from a stablecoin company quietly stockpiling more physical gold than most national governments hold. The question investors should be asking is no longer whether this happens. It is how much runway is left before it does. Welcome back to Currency Arc Insight. This channel exists for one reason: to help serious investors see what is building beneath the surface of the financial system before it becomes the story everyone else is reacting to. Today's briefing brings together a major price forecast, the currency and bond market stress behind it, who is already positioning ahead of the public, and a warning sign at the retail level that deserves far more attention than it is getting. There is a specific kind of credibility that only comes from 5 decades spent inside the machinery of Wall Street, watching cycles form and collapse under every kind of market condition. That is the credibility behind one of the boldest precious metals forecasts circulating among serious investors right now. A veteran strategist has laid out a roadmap placing silver at $1,000 an ounce and gold at $20,000 an ounce within the next several years. This is not a number offered for shock value. It is a 2-stage thesis, and both stages matter. The first stage is near term. The analyst describes the metals as entering a melt-up phase, where equities, commodities, and precious metals rise together as capital searches for returns in an increasingly unstable monetary environment. His near-term target: $7,000 gold and $200 silver, potentially within this calendar year. Context matters here. Gold spent most of its modern history under $2,000 an ounce. Silver spent years trading in the teens and 20s before its recent breakout. Targets at this scale, on this timeline, represent one of the most aggressive institutional calls currently on the table. The second stage is where the forecast becomes consequential for long-term positioning. After the initial surge, the analyst expects a meaningful pullback, one that shakes out short-term speculators and tests the conviction of newer entrants. But he does not treat that pullback as a warning sign. He treats it as a pause inside a much larger structural move. Because governments and central banks have no viable alternative to continued monetary expansion given the scale of existing debt, the metals resume their climb over the following years, ultimately reaching $20,000 gold and $1,000 silver by the early 2030s. The distinction he draws between a cyclical top and a secular top is worth sitting with. This year's potential peak in the metals, he argues, is cyclical, temporary within a longer uptrend. Equities, by contrast, may be approaching something closer to a secular top, the end of an era, not a pause within one. That reframes any near-term volatility in gold and silver as noise inside a structural bull market with years left to run, not a signal to exit. For investors, the natural question is one of patience. 6 years is not nothing. But measured against a move to $20,000 gold and $1,000 silver, it is a remarkably short window for one of the most significant transfers of wealth into hard assets in modern financial history. Track record is what makes this worth taking seriously. This is not a newcomer chasing headlines. This is a strategist whose recent calls on gold and silver direction have proven notably accurate during a period when many analysts have misread the market. That accuracy is exactly why the longer-term thesis deserves scrutiny rather than dismissal. Skepticism toward forecasts this size is understandable and often comes from those with the least exposure to how fiat currencies behave under fiscal stress. Every fiat currency in history has eventually devalued significantly against hard assets. Record national debt, an accelerating need for monetary expansion. This is a pattern that has preceded major precious metals bull markets before. Investors who study that history rather than dismiss it are the ones positioned correctly when the next leg begins. $200 silver and $7,000 gold near term, $1,000 silver and $20,000 gold over the following years. These targets set the stage for everything that follows. The macro pressure building in the bond market, the currency system, and central bank behavior all pointing toward the same conclusion this strategist has already reached. The fiat system is under mounting strain, and hard assets are where that strain is being absorbed. A forecast this aggressive only holds up if the macro backdrop supports it. It does, and 3 developments in particular explain why this moment may be different from previous cycles. Japan. The Japanese and American financial systems are deeply interconnected, and recent turmoil in the yen has triggered an unusual U.S. response. Rather than the Bank of Japan defending its own currency alone, the U.S. Treasury intervened directly, and the method matters. Instead of selling dollars to buy yen, the Treasury reportedly sold euros. A government confident in its own currency defends an ally using its own reserves. A government that reaches for a third currency instead is signaling something closer to protectiveness about what a direct dollar sale might reveal. When the institution responsible for defending the world's reserve currency avoids using that currency even in a rescue operation, that is not a small detail. It is a signal. The bond market. This may be the most consequential of the three. The 30-year Treasury yield has surged toward levels not seen in nearly a quarter century, climbing more than 70 basis points in a short window. Here is why that matters. With total federal debt near $40 trillion, even a modest rise in average borrowing costs translates into enormous new interest obligations. At current rates, refinancing the full scope of outstanding debt could push annual interest expense above $2 trillion, more than double the roughly $1 trillion being paid today. Compounding the problem, a large share of that debt was financed short-term, meaning trillions must be rolled over at these higher rates within the next 12 months alone. This is the mechanical definition of a debt spiral. Rising rates raise interest costs, which raise the deficit, which raises the debt, which raises how much must be refinanced next at whatever rate the market demands. The dollar. Measured against a basket of other major currencies, the dollar index has broken below the psychologically important 100 level after repeatedly failing to hold above it in recent months. This is not a minor technical footnote. From 2001 to 2011, the dollar index fell from the high 90s to the mid 70s. Over that same decade, silver rose from under $5 an ounce to $50, roughly tenfold. A weakening dollar has historically been one of the most reliable tailwinds for silver and gold, and the current breakdown below 100 places the index back in territory that has preceded major precious metals bull markets before. None of these three developments are coincidental. Currency stress in Japan pressures the dollar system through global capital flows. A dollar under pressure makes treasury debt less attractive, pushing yields higher to compensate investors for risk. Higher yields raise the government's own borrowing costs, deepening the fiscal problem that undermined confidence in the currency in the first place. That is a feedback loop, and feedback loops like this rarely resolve gently. The targets from Part 1 are not being proposed in a vacuum. They are being proposed against a currency system under measurable stress across three independent indicators simultaneously. A reserve currency being defended indirectly rather than directly. A bond market demanding meaningfully higher compensation for long-term risk, and a dollar index breaking down through a level it has historically struggled to hold. History says that when these conditions align, capital moves toward hard assets. The next question is, who is already moving? When institutions with the deepest access to financial data start quietly repositioning their own balance sheets, that tells you more than any forecast could. Two categories of buyers are accumulating physical gold right now at a pace worth serious attention because both operate with a level of financial sophistication most retail investors will never have direct access to. Central banks. Gold purchases by central banks worldwide have reached levels that would have seemed extraordinary just a few years ago, with recent quarterly buying reported in the hundreds of tons. This accumulation has been sustained enough that central banks collectively now hold more gold than they hold in U.S. Treasury securities. That is a fundamental shift in how the institutions responsible for national reserves view safety. These are not speculators chasing momentum. Central banks manage reserves on multi-decade horizons and at enormous scale. A sustained pivot toward gold over treasuries signals a structural reassessment of where safety actually lives in the current system. Stablecoin issuers. This one is arguably more revealing. The world's largest stablecoin issuer, a company whose core business is issuing a dollar-pegged digital tokens backed by U.S. Treasury purchases, has been aggressively expanding its gold reserves. In its most recent quarter, the company added meaningfully to its physical gold holdings while posting well over $1 billion in net operating profit. That brought total bullion holdings to more than 140 tons, valued near $19 billion, making a single private company one of the largest private holders of physical gold in the world. Sit with that for a moment. This is a company whose entire business model runs on issuing dollar-denominated currency and funding it with U.S. government debt, functioning almost like a private extension of the treasury market. And when it comes time to deploy its own profits, the company is choosing physical gold over more dollar-denominated assets. A business built on fiat infrastructure is using its own earnings to hedge against that infrastructure. The company has also developed a tokenized gold product, each token backed by a physical ounce in vault storage, with plans for independent audits by a major accounting firm to reinforce credibility. Two categories of buyers: sovereign central banks and one of the largest private financial technology companies in the world. Both with access to financial modeling far beyond what is available to the average investor. Both with enormous resources to deploy toward whatever they believe best protects value over time. Both choosing gold at scale during a period when the metal has already appreciated significantly. This accumulation also helps explain physical market dynamics playing out elsewhere, including reports of gold flowing from Western markets toward Asian demand centers. When sovereign entities and major financial institutions absorb meaningful quantities of physical gold at the same time, that demand places sustained pressure on price discovery, especially in physical markets where available supply is far more constrained than in paper trading markets. Central banks and major financial institutions do not accumulate hard assets at this pace without a clear strategic rationale. Their continued buying at already elevated prices suggests they do not view current levels as expensive relative to where they expect the currency system to go. The next question: how much room does silver specifically still have to run? Few tools are as historically reliable for gauging silver's relative position as the gold to silver ratio. How many ounces of silver it takes to buy 1 ounce of gold. That ratio currently sits near 70 to 1. Where it has traveled during past bull markets offers one of the clearest frameworks available for what may still lie ahead. Earlier in this cycle, the ratio stood closer to 45 to 1, meaning silver has actually grown more undervalued relative to gold, even as both metals have climbed. That matters because major silver bull markets have never ended anywhere near current levels. During the 2001 to 2011 run, the ratio compressed to 32 to 1, alongside a move that took silver from near $4 to nearly $50, a 12-fold increase. Going back further, the historic 1970s bull market saw the ratio compress to 14 to 1 by January 1980, with silver rising nearly 40-fold from roughly $1.30 to $50. Applying these historical compression patterns to today's cycle produces a useful framework. Silver's current bull market began near $18 in 2022 and has so far produced roughly a 3-fold move to its recent price near $59. Replicate the 12-fold move of the early 2000s and silver clears 210. Replicate the 40-fold move of the 1970s, and silver approaches $700. Neither should be read as a near-term price target. Both are a reminder that silver bull markets historically have not ended with the ratio anywhere near where it sits today. This pattern also explains why sentiment towards silver can feel disconnected from the underlying fundamentals. A 20 or 30% pullback from recent highs feels discouraging in the moment, but measured against where the metal traded a year earlier, or against the scale of previous bull cycles, that kind of pullback looks far more like a pause inside a larger structural move than the end of one. A related development strengthens the case further. A widely respected technical analyst, known for accurate calls across stocks, bonds, and major markets, has argued that mining equities may be positioned to significantly outperform the metals themselves. If gold and silver rise roughly 30% from current levels, his analysis suggests mining stocks could see gains closer to 90% or more, a multiple effect seen in previous phases of precious metals bull markets. The mechanics are straightforward. Mining companies carry embedded operating leverage. A fixed rise in the metal price they produce translates into a much larger percentage gain in profit margins, since production costs stay relatively stable while revenue rises with the metal. What matters even more than the leverage math is what renewed strength in mining equities signals for the broader market. As mining stocks begin posting outsized gains, that performance draws in generalist investors, capital that has largely sat on the sidelines of the precious metals sector throughout this cycle. Broader participation, even from investors who never buy a single ounce of physical metal, reinforces upward price momentum across the entire sector. Ratio compression and mining equity leverage point toward the same conclusion. Current levels in both silver and the broader mining sector may still represent an early stage of a much longer move, one that history suggests has not yet reached the extremes that have marked the end of previous cycles. One signal remains, and it may be the most important one in this entire briefing. Every part of this briefing so far has built the case for higher gold and silver prices. A bold forecast, mounting currency stress, sophisticated buyers positioning early, and a historical ratio with significant room left to compress. This final part addresses something different and arguably more urgent. Growing evidence that the traditional banking system is beginning to actively restrict the ability of ordinary investors to convert fiat currency into physical precious metals. A recent case illustrates the pattern clearly. A customer attempting a routine wire transfer to purchase physical gold and silver was subjected to invasive questioning by her bank. Where else she had purchased precious metals, and where she stored her existing holdings. These are not standard fraud prevention questions. They probe the extent of a customer's precious metals activity, information with no legitimate bearing on processing a routine transfer. What happened next is the more troubling part. After raising concerns but proceeding with the transfer anyway, the customer later found herself locked out of her own account. The bank offered no explanation over the phone and had nothing in writing prepared when she visited in person. She was told the account was closed for suspicious activity. Funds tied to a certificate of deposit were retained. Her checking account was closed outright, all stemming from an attempt to move her own money to buy a legal, tangible asset. This matters beyond the individual case. It illustrates a pattern serious investors should watch. Banks treating the conversion of fiat currency into physical hard assets as behavior worthy of suspicion, sometimes resulting in account restrictions with little transparency and no meaningful recourse. When a routine legal transaction triggers this level of institutional friction, it raises a real question about how comfortable the banking system actually is with capital exiting its infrastructure for physical metal. This case alone has reached well over 100,000 views, a strong indication that many investors have experienced or grown wary of similar friction when moving capital out of the traditional banking system and into physical precious metals. Whether this is an isolated compliance overreaction or an early sign of broader capital controls tightening around the exits remains to be seen. It is a pattern worth monitoring closely as gold and silver continue their structural advance. This is where the entire briefing converges. The forecast for $1,000 silver and $20,000 gold rests on a foundation of currency stress across Japan, the bond market, and the dollar. That stress is already being met with quiet, sophisticated accumulation from central banks and major financial institutions, positioning ahead of the public. Historical ratio analysis suggests silver still has substantial room to run before this cycle reaches the extremes that have marked the end of previous bull markets. And now, friction is appearing at the exits, early resistance from the very banking system that stands to lose the most as capital moves from fiat currency into physical hard assets. The most important takeaway may be this. Despite everything outlined here, public sentiment toward gold, silver, and mining equities remains near some of the lowest levels of this entire cycle. Historically, deteriorating fiat conditions paired with depressed public enthusiasm for the assets best positioned to benefit from that deterioration has marked some of the most favorable entry points for long-term investors, not the least favorable ones. The setup described across this briefing is unfolding quietly, largely outside mainstream financial media attention, while the fundamentals continue building in favor of higher prices ahead. For investors paying attention now, before sentiment shifts and before the broader public starts asking questions about gold and silver again, the window described throughout this briefing remains open.